the process until the holding model comes out. We will look at how the holding model and formula for financial engineering came out. There are several interest rate models, but I will describe the process of developing holding model. Through this process, we will learn about the disadvantage and advantage of various models. It will proceed in the order of Merton model, Basic model, CLI model, and holding model. The background of finance engineering. Finance engineering is a compound word of finance and engineering. Financial engineering is a combination of management, statistics, industrial engineering, and applied mathematics. The beginning of financial engineering is the back-school model. The back-school model calculates the price of options using Ito calculus or stochastic calculus. It has established an axiom that arbitrage is impossible. The relationship between the spot of stock and the futures price and the risk-free bond price was established. Through this, the equation was obtained. It can be obtained numerical solution through probability theory method. However, there is a gap with the spot market. There is criticism that this is the main culprit of the financial crisis because it growth bubble. Merton model. It was developed by Robert C. Merton. It is a widely used credit risk model in 1974. Analysts and investors fulfilled their financial obligation through the Merton model. Debt was repaid and the possibility of becoming a credit delinquent was measured. The basic assumption of the Merton model is all options are European and are exercised only at the time of expiration. No dividends are paid out. Market movements are unpredictable. No commissions are included. Underlying stock volatility and risk-free rate constant. Return on underlying stock are regularly distributed. The capital value of shares of nominal value of debt determined by the value of the whole company. In other words, include debit modeled by value for the call option, the value of capital market, the volatility of asset market value will depend on the company. Equity investors are protected by principle of limited liability. Shareholders will not repay their debt if their corporation value is less than their outstanding debt value. In other words, you choose repayment without liquidation. The Merton model regards bankruptcy as a continued probability of default. In the case of default, the stock price of the default company is assumed to be zero. Basic model that was introduced in 1977 by Ulrich Wolfgang Basic. It is a model that mathematically explains the evaluation of interest rate. The Basic model is the only source of market risk driving interest rate movement. Therefore, it is a type of short-term interest rate model. The Basic model was applied to the credit market as it was used to evaluate interest rate derivatives. The Basic model is the form of adding the mean reversion process in the Merton model. Unlike other models, the Basic model captures mean reversion, an essential feature of interest rate. Therefore, as opposed to stock price, interest rate cannot rise indefinitely. This interferes with economic activity and can cause interest rate decline. Interest rates do not decrease below zero. As a result, interest rate move within a limited range. It shows a return to long-term value depending on whether the interest rate value is greater and less than the long-term average. The fluctuation may be positive or negative. CR model. It was introduced by John C. Cox in 1985. The CIR model is a mathematical formula used to model interest rate movement. The CIR model explains that it's the only source of market risk. This interest rate prediction method is based on stochastic differential equation. The CIR is used to cost international rate and in bond pricing model. It is also a model that uses square root to prevent calculate interest rate from always being negative. The CIR model determines interest rate move as a product of current volatility, average interest rate, and spread. Next, introduce market risk factors. The square root does not allow negative interest rate. Therefore, the CI model assumes an average reversal at the level of long-term regular interest rate. Negative number can be prevented by applying root to the volatility term. However, it is nature that volatility cannot be negative, but interest rates have a problem in that they can also be zero interest rate. CHOI model. It was developed by Thomas Ho and Lee Sang-bin in 1986. The CHOI model is short interest model widely used in bond, option, swap, and other interest rate derivatives pricing and future interest rate modeling. The CHOI model implies the form of delta t. Through this, it is collected according to market data which can accurately return the bond price, constituting the yield curve. The correction and subsequent evaluation of bond option, swap, and other interest rate derivatives are generally carried out through a binomial lattice-based model. Cross-form valuation of bond and black-like bond options are also available. It does not include meaningful return. For both these reasons, models such as black Dermentoy and whole white are often preferred. In the wholly model interest rate value can be negative. It is much more flexible than CIR model. It has been developed in the other Merton model, basic model, CRI model, and Holding model. It is showing signs of supplementation over time. However, the Holding model is not perfect model. Over time, the whole white model, which complemented the Holding model, came out. As new financial engineering models emerge, more and more supplement models are emerging.